Hey everybody, happy Tuesday. So we've talked to Mitch Shaw, Tyler Morse, Al Patel, and Chip Rogers. We've talked about politics, we've talked about PPP, we've talked about the CARES Act, we've talked about safe stay, we've talked about opening safely, clean rooms, we've talked about armbands, and we've talked about the Hawks. But where's the money? Today we're going to talk to the bankers. Stay tuned to find out. Hey guys, thanks for joining me. Another edition of Teague Talks. Today I got Sanat from Avana Capital, I got Mat Crosswy from Stonehill, and I got Sushil from State Bank of Texas. I appreciate you guys being here. I think people want to find out, right? Banks are kind of at the core of all of this. So I think we want to talk to the lenders. And I think we want to find out forbearance, foreclosure, and where we go from here, right? Making new loans. So before we start, Matt, I don't know if you tell me what you're seeing at Stonehill, a private bank. I mean, that's a new debt fund, which is a new entity in this world. So what are you guys seeing?
Yeah, so we're a private debt fund, meaning we really aren't regulated by the Federal Reserve or any overarching authority. So how we manage our investments is really predicated on us as investment managers and fiduciaries for our investors. Most of our portfolio, going back to early March, we began to review our portfolio, and then into April we started having many requests for just 90-day forbearance agreements for a relief of debt payments, which we reviewed, and we reviewed those on a case-by-case basis. But the majority of our portfolio we did forbear, and that's really how it's set up right now. We tightened the reporting requirements in terms of we want weekly STAR reports, we want regular business plans, we want more phone calls, we want to understand week in and week out your business and how this recovery and this ramp up coming out of this recession is going to look for you. And so that communication is extremely it's extremely important for us as we we have this 90 120, depending on whether we received a payment in April. We have this kind of grace period where we're evaluating every deal, and then we're going to make our decisions on how we proceed next, and based off when we have more visibility. I mean, I think everybody knows this environment changes weekly, and everybody's curve changes weekly as well, from a V to a U to a W to a swoosh to you kind of name it. But nobody really knows, because you're trying to forecast medicine and science coupled with the depth of the recession that we're going to be in coming out of this, and what that recovery will look like. So for us, it's market to market, communicate with us, provide information, and we're here to work with you.
Yeah, that sounds familiar. Sushil, you guys seeing anything different?
A lot of the same. I think right now, my whole world has been PPP. We're trying to get capital out to people that need it most. And, we are a FDIC insured bank. So we're part of the PPP program. We're one of the lenders. And we're trying to basically treat all customers that we have and get capital into their hands. And then we're even doing a lot of business with non-customers that have come to us through referrals, etc. What we're seeing is this is giving an opportunity for a resurgence of real community banking. And we like that. That's a positive, I think. We're really getting a chance to shine as a community bank, and showing people what the difference is between a big box bank or a bigger bank versus a community bank, where people have my cell phone numbers, or people have my brother's cell phone number, and they get what they need to get done ASAP. So that's what we're seeing right now. It started back in March. We, of course, are going through the deferrals, the forbearance, the interest only, some of the modifications. We started looking at our portfolio in different segments, select service versus mid-scale, economy, independent. And what we're finding is that the lower the scale, the better the occupancy right now, and ability to even make some type of interest payments. And then the higher the scale, the worse the occupancy, and probably the more the forbearance. what we see going forward is exactly what Matt said. We don't have visibility yet. I don't think anybody has the crystal ball or visibility, so we're following the guidance. What is most of concern on our minds going forward is, how are regulators going to react? And we've seen a lot of good guidance that have come out, and I've been involved with some of the lobbying efforts. And it's helpful and it's positive for banks to see that, the regulators are going to work with the banks so that the banks can work with their customers. And I think that's been very encouraging as a lender and as a banker. As far as new loans go, we in fact, I have about 4 or 5 pending loans, but we're going to fund them, and they're new loans that have come in the last 2 weeks, and we're doing them because they're existing clients of the bank, and maybe we add in a 1-year interest reserve that's funded by the borrower up front, along with higher cash down payments. So we're still very conservative on our loan amount. And at the end of the day, we have experience with these clients, and we have a trust relationship that goes back several years, and we have confidence that they'll be able to weather the storm. And we show them that confidence by funding some of these deals.
So give me some idea of the size and the terms of the new loans.
So there's one in about a $15 million range in Bronx, New York. There's another one in Port Arthur in the, under $5 million range, right? And then there's a couple add-ons to existing projects, where there may have been some construction cost overruns, and we're taking it over from another lender, things like that. But that's kind of what we're seeing, and what we think. At the end of the day, we always think the lending relationship is most close to like a husband and wife relationship, and you got to get through crap together, right? Yeah. So and you got to enjoy the good times together. So we keep that philosophy in the back of our mind. Now is not the time to start thinking of any type of divorce or anything like that. Like, now's the time to come together and really, be there for each other. And as Matt said, communicate. I tell people, if you don't communicate, that scares me. And same thing happens as any husband and wife relationship too. So I think that's the most good analogy I can give.
Sushil's trying not to get a divorce. I like it. Sanat, how does this compare to what you're seeing?
Well, first of all, I want to thank Sushil for the therapy session. I won't have to go to see my therapist. I appreciate that. Really thankful. Hey, if it's cheaper, let's just do this every week. It's a lot cheaper for me to do that. To echo what Matt said, as well as what Sushil said, it's communication. When the onset of COVID came in, we started talking to our borrowers that first week. And we started talking really the end of February and first week of March and saying, hey, this is coming. What are you guys seeing? What are your plans? What are your contingency plans? So we were able to work through those situations. And I think we all said, did they make the April payment? Did they make the May payment? So we're talking to them weekly, looking at their manager's report, what have they got in occupancy, to also add Sushil's commentary. Sushil, the lower the scale of brand, the better the performance of the asset. So that's something we're envisioning this time around. But more importantly, I think what we're seeing in the market is there were construction projects that are being stalled midstream. Banks basically, or even private debt funds, which is what we are, that basically have had their warehouse funding or any Wall Street type funding dry up. And as such, now their projects are developers that get stuck in the middle. We're trying to figure out how to finish the project. So we're seeing some what I call orphan construction debt. We're seeing projects that had finished completion or are a month away from C of O and now need to get some long-term, some mini firm type structures. So we're seeing some of that. And that's what we're lending in. But also to Sushil's point, as part of that therapy session, we're over communicating with our borrowers, and we're over communicating with our third-party partners and everybody just to make sure everybody's in tune of what's going on in the economy, and everybody's trying to get some visibility of what's really happening and what next week will bring out, and so on and so forth. I think, like for all of us on the call, I think states are opening up, so now we're all waiting to see what happens, how the recovery comes back as a result of the opening up, and then keeping one eye to the other side of, like, is there a resurgence in infections or in cases? So those are factors we're looking at. But lending wise, we're still open for business. We're doing construction lending. We're doing new loans. We committed to a purchase financing transaction. Something in the 60 to 70% LTV on a conventional basis to let them stabilize it and go from there. So in that regard, I think we're still bullish on the industry as it relates to the developers as well as the borrowers that are in there that are experienced. And I think, to Sushil and also to Mat's points, experience means a lot to all of us right now, because if we've gone through something with you and we've seen you perform, it gives us comfort to know that you've got that depth of experience, and we've seen how you perform in good or bad times, and we'll come through this. So that's what we're looking at.
Matt, I'm assuming you guys are doing new loans too.
Yeah, so we're doing new loans, but it's all kind of relative to the market and opportunities. There is pretty much zero liquidity, very little liquidity in the hospitality space right now.
Right.
There was a recent CMBS securitization, which was great news, that went off really well at the end of last week. But again, there was no hotel collateral within that securitization. So you have CMBS that shut down. You have banks that are shut down because they're going through all these forbearance agreements. So it's very difficult for them to book a new loan, while on the flip side, they're forbearing payments across about 100% of their portfolio. And then insurance companies, I think they view it the same way. So all of a sudden you had a very efficient market going back 2 months ago to pretty much zero capital liquidity today. So we're looking at a number of deals. You have maturing CMBS loans that are 10 years old that have amortized down, that are they're maturing and they're kind of stuck, and we're probably being a little bit more flexible on the prepay with some of those borrowers to just bridge them to a year where, we think that the basis is, just a great number. The brands are great, Hilton and Marriott, select service, growing markets, very stable markets that we think will come back sooner than some other markets. So it's just being thoughtful, relative to kind of everything that we're seeing in the industry, because we're seeing a lot. We're seeing a lot of construction. We're seeing a lot of different opportunities. And I will say simultaneously, we're still trying to manage through any deals that were in our pipeline that we had, term sheets out on. The deals might have changed, but we're still trying to work through those deals as well, because a lot of those are previous borrowers and relationships that are known commodities that we have that we want to take care of, that we want to continue to do business with, good or bad. And that's the value of a relationship and that communication and building that level of trust, that we'll still find a way to work through, even if it was a legacy deal, kind of pre-COVID, to appropriately structure those deals and see if we can find a resolution. So we're looking at anything and everything still, yes.
How much of this do you guys, this was sort of the group, but how much do you guys, here you're still open for business, you're lending, oh, by the way, you're working relationships, existing borrowers, new borrowers. How much of this, my sense is it's because of the makeup of who the three of you are as lenders, 2 debt funds and 1 community bank. Whereas I think for the most part, everybody else thinks the banks are closed and they're having a real tough time finding any money if they wanted to get some. Sushil, how much do you think, I'll ask you, is it because of the makeup of who the three of you guys are?
I think it's 100% because of our makeup. We're a niche lender. We're a hotel-focused bank, and we've been around since 1987. We've been through recessions. We've been through good times and bad times. And, we have a comfort level with that asset class. So that gives us confidence that, we know what we're doing, even in the bad times. The issue with a lot of other lenders or a lot of other banks, especially when it comes to hotels, is they're there when the sun is shining, because that's an easy play to make. But when the sun is not shining, a lot of other lenders will get skittish because they don't have that niche or that experience. So that's the main reason why we're still in it, and we still are confident in making some deals. But there's also a lot of quick no's that we're doing right now. Like, we're getting hit up maybe left and right, but there's a lot of quick no's. We're not stringing people along. We're just saying, no, this is not going to work. Or, if there's something that we think is there, hey, we'll quickly put it out there in 24 hours or 48 hours. Say, hey, look, this is what we think we can kind of get done. If it works for you, or if we're in the ballpark, let's talk. If not, let's move on.
Sanat, who doesn't make it out of this? Big banks, CMBS?
I think it's not a matter of they'll not make it out of it. I think their asset appetite will change. I think big banks will, as Sushil said, they come in when the sun is shining, and what they're realizing is that you have to be in it for the long haul, the good times and the bad times. And in the bad times, it's how you negotiate or how you work with your borrowers that will get you through to the other side of it. So I think the big banks are going to have to either wake up and figure out how to lend to this asset class or truly just get out of it. CMBS has to have, that's a wholesale system change. You can't put everybody into a special servicer just because they didn't make their payment because of this 90-day window or this 120-day window. And again, I don't have the right solution for you, but I can tell you there's got to be sort of a medium ground, because the minute you put them all in the special servicer, the ownership group loses rights, they lose, and all of a sudden it becomes that person's asset, and they now try to tell you what to do. At the core of it, and I think Sushil will echo this, hotel owners succeed because they're able to roll up their sleeves and work the system and work how to work their local micro market to get business in their doorstep and try to work from there. If they're not able to do that because somebody else now, a special services as well, you got to bring in this management company to run it and layer up your overhead a little bit more, that's going to create more problems. And I think so there's got to be some flexibility. I don't have the right answer of what that is, but there's got to be some flexibility. Otherwise, you know what? These assets that have performed really well in good times and maybe had a hiccup right now, they're going to come back up again. And it's just a matter of trying to figure out when they'll come up and working through that until they get to a point where they'll be good again. That's really what I think it's going to go.
Teague, just to chime in, I think me and you had a conversation about this. You had CMBS 2.0. We kind of went through that phase. And
yeah.
Now the next one will be 3.0. But I think fundamentally, there's going to be a look back to say, is the hotel asset a right candidate for a CMBS structure? And I think there's going to be a little bit more serious look at that and going forward.
So great question. I totally agree with you. So what happens when it's a no? Who fills that space? Because that was a big space they were taking up.
Yeah. Well, I think the private debt funds have been raising a lot of money in the past 2 years, and they're stepping up their game. And, Stonehill included, and there's so many others.
But it's even those private debt funds is part of the challenge in terms of how they're structured.
Yes.
Whether through those repo lines where really the line lender controls the deal, or a CLO, which is another securitized loan product. And really when there's not saying they have to necessarily be regulated, whether it's CMBS or CLO, but it's a bond instrument that's governed by a contract, and then you sell off, basically a number of different tranches of bonds, and nobody really inherently, you have the servicers within that trust that service it, but they really don't make decisions because they have to adhere to this original contract that they entered into. And so it's kind of this mismatch where nobody really wants to make a move. We were talking with somebody on the CREFC Council, Commercial Real Estate Finance Council, and he's like, I get what, the Fed can do here and there, but they're all regulated. We have contracts that we can't just necessarily amend or modify because that's across, billions and billions and billions of dollars of assets. And while I hear that on one side, on the other hand, TALF money is what's keeping, their industry alive and allow them to issue new securitizations, right? So they have to, at some level, adhere to what the Fed is doing for them on the come and allowing them to continue to issue new securities. So, but you're right. It's not a match in terms of, you really do need a true asset manager and servicer that understands the hospitality industry, that can make decisions on behalf of that borrower and that individual loan, not on behalf of some larger trust that's used to some fixed income product, because hotel cash flows can move so quickly. They're so volatile. It's not a fixed income commodity.
Sanat, any comments to that?
No, I think what Matt said is accurate. I think it's gonna, and what Sushil, CMBS 3.0 is going to have to look at hospitality assets and say, how do these assets really react in the effect of a downturn? And is the way of throwing them, managing where with special services and liquidation and whatever, is that the right strategy? I don't think it is. I think in reality, you've got to look at it as an asset that has cash flows that fluctuate. And when they start fluctuating in that cycle, how do you get ahead of it? So I feel realistically, I think when we do come out of this, there's going to be a different, I think hospitality assets going to be looked at differently in terms of how can they be underwritten and what are the measures we need to do to instead maybe have greater reserves, maybe build in, have structures rather than have reserves for just CapEx. We should have reserves that build in a P&I reserve or 6 months or something like that. Maybe that's something, if all the CMBS portfolio today had a reserve that was for payments, basically, they could say, okay, for the next 6 months, we'll do an interest only, and maybe we'll drive this out in sort of P&I payment for 6 months, and let's see if it smooths out and comes out of it. In that time, you can start structuring something as a solution. Right now, instantly they don't make the payment, instantly go into special servicer, and now you're in forbearance and you're in a liquidation. That's not the right answer, I don't think.
The answer will come about. Truly, it'll be whatever the market and the bond market bears. So, can it be that the FF&E reserve for CMBS loans, can that in the future in CMBS 3.0, can that have a flex feature where it's used also as a payment reserve? If you do, I don't know what the study would be to say how much of FF&E funds are actually used by the borrowers on these CMBS loans. I think that would be something interesting to look at as they structure 3.0. But hey, that's 3.0. I think we're a long way from that. I think right now it's going to be dialed back to 3 months and then another 3 months. And as a regulated institution, all of the federal guidance and all that has come out, gives good guidance up until 6 months. But then the concern that banks have is all these accounting rules start coming in. And I think funds have the same, So how are these accounting rules, such as TDR rules and non-accrual rules, how are all of those going to play? And there's a lot of chatter, which is positive in Congress right now on, what to do. What I have found is, leadership at the FDIC and Federal Reserve are all, looking at this with the lens that, hey, we're all on the same team with the banks. It's not us against you, kind of like how it was in 08. In 08, it was that banks were being punished because they were bad actors, and they had over-leveraged everything. In what I'm seeing in this time period is a real coming together between institutions and the federal government and the regulators to say, hey, how can we get through this together, work together? It's really encouraging.
Yeah. Sanat, how are you seeing this different from 2008?
Exactly what Sushil said. I think in 2008, it was a crisis in confidence in the banks, basically, because they were not so much as community banks, but maybe the larger banks were, portrayed as bad actors. I think us coming out of this is a function of, we still got, this is a very viable industry. Let's all agree on that. I think everybody on this phone agrees that hospitality as an industry is here to stay. It's not going to go away. I think what's going to have to happen is there's going to be sort of a marrying of still a public and a private partnership, where in the last financial crisis, for example, the government put in a program, and I think, Sushil, you may know of this, and Matt, you as well, the FMLP program, where the lenders did a first mortgage program, and this is tied to SBA, so give me just a second here, but the first mortgage was partially guaranteed by the government as well. Well, if there was some essence of a program that's like that the Fed has as a tool in their toolbox that works, then this industry could come out of it and maybe still lend on a long-term basis in that program. To put the point Sushil made, having FF&E reserves have a flex that they can go towards making P&I reserves or whatever, that's helpful. Because today, think about it, when this happened, all the franchisors came up and says everything on PIP, everything in regards to renovations, repurpose, rebranding is now on hold. We're going to give you time to go do that. Well, in CMBS loan documents, I don't think it's written where it says you can turn around and immediately start using that as payment. That's actually up to your special servicer to make that determination. And they solely decide, and you can't control and say, can you use that? So I think those things have to come into play. Those fixes have to come into play. Plus, I think this program of truly a public-private partnership where maybe the government provides some level of a guarantee or some sort of a backstop, even if it's not the full amount of the first, maybe it's 50% of the first, we'll get lending going back into this segment.
Yeah, I'm just thinking, I wonder when that's going to happen, right? I mean, right now my head's still going to, all right, everybody's kind of got a 90-day forbearance. Okay, what happens on the 91st day?
I think in reality, I think it's to Sushil's point, that guidance will come about in 6 months because somebody's going to wake up magically in 6 months and realize we still have to lend money. Otherwise, we're going to have a whole lot of portfolio going sideways on us. You got to figure out how to do that. So I think that'll be another tool the Fed comes out in their toolbox and says, this is what we're going to do about it. I think that's really, that's if I'm hoping that comes around because that was for lending back again in this. Because the debt funds can do it all. We just can't. We don't have that level of capital. I mean, Matt, tell me, there's not that much capital out there. I mean, how much in CMBS issuance was hospitality? I think this year I read a number, there's like 7 billion in hospitality that's maturing this year and another 7 or 8 billion that's maturing next year.
And keep in mind that's maturing off 2010 numbers where there's very light origination. So, I mean, there's not enough liquidity in the market to solve it. You have to solve it through, and servicers are okay. We'll allow you to use your FF&E reserves. Okay, that's just kind of just throwing a little bit at this problem, but not every downturn will be this bad. Hopefully, so we don't need to also have this knee-jerk reaction where the pendulum swings so far the other way. But there does need to be a lot more thought on based on the upfront underwriting and then the ongoing servicing and management of these loans. That's for sure.
So talk to me about sort of your existing portfolios. And I get it. Everything right now is not performing. I understand that. But when do you start seeing you guys having to make those tough decisions of having to take hotels back, foreclose, et cetera?
I don't think we're at that point yet or anywhere close to that. Yep. And I don't think everything is not performing. One of two of our largest borrowers have basically come to me and said, "Look, we're going to make all of our payments. Well, we have liquidity, we have recourse, and we're going to stand behind this, and we're going to make all of our payments." So you have some like that. Then you have some who, as you get lower into the scale level, they're saying, "Look, why don't you let me loose on principal? I'll continue making my interest payments." So in our portfolio, I would say we have about 25% where there's some forbearance, where there's no payment, coming in, or there's maybe a real estate tax escrow only coming in. So about 25%. But the rest, we're having, as of right now, we're still getting interest collected on. And so I don't think that, I think as we go further along, then it will increase, right? But by the same token, you have some states reopening. Texas is just reopened, kind of, and we're seeing 10% bumps in occupancy levels immediately from Port Arthur to Dallas to Texarkana. So it gives some positive vibes that, hey, we're going to get through this. I think it's not going to be all doom and gloom. I think America as a country and as a people quite resilient. And I heard the interview with Mitt where he mentioned about spirit, and I thought that's very a good way to put it.
Yeah, you got to believe in the human spirit. Sanat, talk to me about your existing portfolio. What do you see from default rates and pressure?
Knock on wood, we haven't seen anything default yet, so that's a positive.
Yeah.
Similar to what Sushil said, we had to go in and talk to some of our borrowers and restructure some of their debt. But everybody's making either a full interest only payment. Some are making a full P&I payment and reserve and the taxes and escrow and all that still is happening. And in some cases, we've done an interest only, but we've deferred a portion of the interest till 6 months out. So everybody's making some level of a payment. We have one loan, and actually it's an SBA 504 loan in our portfolio that is on full deferral, but it's in the state of New Jersey, and it was not for a hospitality, it's for actually an alternative type of business. And because the state of New Jersey shut down, put everybody on a shutdown, they were not able to drive any revenue. So they were on a full deferral. But even them, they went on a deferral as it relates to P&I, but they're making a partial interest payment. So we're fortunate in that regard. And as I said earlier in the conversation, we started talking to them at the end of February, first part of March, and saying, what's your outlook? What are your reserves looking like in reference to that? I think by doing that, we're saying, okay, we're managing now for the next 6 months through the end of September. And let's see what happens at the end of September. And then if the states reopen up, what's your path of recovery? I think Matt or Sushil said, it's either a U or Nike swoosh or a V or whatever. It's going to be whatever it is. Right now, it's a borrower by borrower specific discussion because we're saying, what are you doing in your micro market that's helping you get your business reopened? And we had a borrower in Georgia, and they opened in 2 hotels, and they said this past weekend they were at 80% occupancy, and they were in the Marriott Hilton brand hotel. And we're like going, wow, that's surprising. And he said, yeah, I know. I don't know what's happening. It's the fact that people are wanting to come back. One borrower does not make a trend, so I'm hoping I get more stories like that. Little by little that people are resilient and coming back. But I think to the point Sushil and Mitt made, it's the human spirit, and it's people being resilient about making sure that this is their livelihood, and this livelihood continues to prosper and succeed. So our portfolio, thankfully, is performing in the sense that we've had nobody be on a full default or anything to that effect. So, and that's giving us confidence that why we should continue commit to this industry and blend into this space, because we've got borrowers that are making their efforts to sustain their business.
To that point, I just want to add something, and then I'll let Matt talk. But the key to our success at our bank is our clients. Our clients, 90% of our loans are to Indians, mostly with the last name Patel. And what we have found is our community really has the ability to roll up their sleeves and still operate properties at very lean levels, and they're not afraid to do that. So we don't have, but for maybe one loan where there's a management company really involved at all. These are owner operators, and I think that's the true reason for our success is because we deal with owner operators and not a lot of the larger companies.
So I should be wrapping this up because of a time perspective, people's ADD kicks in, but I think it's really good. So I'm going to keep going because I have some more questions. Matt, listen, from what we're seeing, we're not seeing the stress, and guys like the three of you, which I think you guys are hoteliers first, and oh, by the way, bankers second. At least that's my way of describing you. So I think you're unique a little bit in our industry. You're going to work with the borrowers. You're going to understand the problems that they're having at each individual hotel. So I think you guys are what hopefully the future looks like. However, there are the people, the CMBS, the big banks, where they're not doing that. I do think people want to know what distress looks like, partially from the opportunity side. What we're seeing is interesting. The things that are being done right now are the note sales, right? Sort of Wall Street note sales. So I'd be curious, Matt, or any of you guys, what you're seeing, if you can help. Oh, by the way, if I'm a borrower and my lender calls me and says either I see my note on the market or if I get the opportunity to buy my note, can you guys help step in and help me buy my own note?
I'll say, it is starting. There's a little bit of a gap between the bid and the ask, going over the last month. Is yes, we are looking at notes to purchase. We've always been active in that space, going back to 2010. So we will stay active. Now, will we kind of negotiate and have conversations with the underlying borrower? No, we're under CAs, and there's certain things that we can't do and conversations we can't have. But once we are that lender, are we going to asset manage that very similarly to the way that we're going to asset manage our own portfolio? Because we do view, to Sushil's point, to Sanat's point, we do view the underlying borrower as the best owner of that property. They view it the most. They put probably the highest valuation around that asset. They know that asset well. They know that market well. They know how to ramp that property back up. So we're going to work with that underlying borrower. But the loan and the loan documents and everything that's in there, it's put in place to protect us if that borrower doesn't do what they're supposed to do. And in that situation, and you talk about cash management. No, we don't want to trigger cash management on a borrower that's already in distress, especially if they're trying to do everything that they're possibly trying to do. That's just there in the event that we need to protect cash to protect our position because they're not doing what they're supposed to do. So there is opportunity. We are looking at notes to purchase. We're having a lot of ongoing conversations. We're talking with groups about, preferred equity and restructuring deals that were about to be financed and maybe, paying down the senior and recapping the deal and putting up operating reserves and working capital. It's a pretty wide net that we're casting in this market because every deal is so different. And a lot of groups on the equity side, the feedback, we're going to need some cash. We know we will to make it to the other side. It's just now's not the time. But again, based on your reputation and how you've worked with people and treated them in the past, you will be one of our first calls. And I think that goes for everybody on this Zoom meeting.
Sanat, if I'm a borrower and I get an opportunity to buy my own loan because my banker is selling it, can you help me buy my own loan?
Yeah, we can help you. We can help you look at that note, and basically, we can take the position of either buying that note directly from the bank, or we can take it where it's a note-on-note type financing structure. The second one is latter is a little bit more complicated, requires a little bit more structuring and a little bit more in terms of equity and things like that. But it also, as to Matt's point, the bid and ask spread is quite wide right now.
Yeah.
And I think that spread will compress as time progresses in this, and specifically in this industry right now, hospitality. So I think to answer your question, we can definitely help you. I think you also have to have realistic expectations. The bank's not going to take a haircut right off the bat. They've got to figure out what's your ability. They're looking to sell the note purely as a function of managing balance sheet risk and avoiding future regulatory scrutiny in that sense. So, if you're thinking you're going to get it for pennies on the dollar, I don't think that's an expectation you have. That's an expectation you should start with. But we can definitely help you on a note-on-note, or if we step in and buy the note from the bank as well.
Where are the opportunities coming forward?
We're seeing it on projects that are, and Matt and Sushil maybe you can chime in as well. We're seeing it in projects that are near completion, that the banks are not patient to see if there's going to be stabilization. They're worried that the valuation is in such flux because everybody's now talking pre-COVID value, post-COVID value, and where the two, and then what's the post-COVID stabilization ramp compared to the pre-COVID stabilization ramp. So it's really driven by that. The way we're looking at it, I think all of us on this phone, on the Zoom call, we have some basic fundamental underwriting that we've done, and that's why we're staying in this business, in this industry. As long as what we're helping you buy or helping them finance, it fits under those guidelines, then we're going to be able to continue helping you. But if your expectation is where you are highly levered, and you're going to have to really have an expectation, you're going to have to bring in some skin in the game for us to come in and step in and buy it. And maybe as you prove out your results, we can get you back to that leverage. But at this point, you're going to probably need to bring in some sort of an equity kicker or some pref equity to kind of resize the loan a little bit if we need to do that.
And I would add one more thing, and it goes back to the communication with your existing lender. Again, a lot of these deals were underwritten well, and they weren't over levered, like going into 9 and 10. So you really don't need to think of discounts even to get to probably where the real estate is valued at today. But maybe you do just need a little bit of a pay down of your loan or an interest reserve. And in today's market, if you're forced to sell because you're not being a good actor, it goes back to there's no liquidity in the hospitality space, and the value of that existing loan, that value of that existing senior mortgage is so valuable to the overall value of that real estate in today's market versus doing an outright sale in distress where you have to bring 100% fresh cash to any acquisition, whether it's real estate or debt. So there's a lot of value in that underlying loan. And so that there's a lot of importance in making sure that if you think your money good, make sure you definitely protect that mortgage that you have in place.
I love it. I think that's so well said. And gentlemen, I am going to wrap it up now. I think that was a great way to end it. Thank you very much for coming on, talking with us openly and candidly. I think this is the kind of stuff people want to hear. Hopefully for your borrowers and for your future relationships. We wish you all the best. So thank you guys for your time. I appreciate it. We'll be in touch.
Thanks for
Likewise.
setting up.
Thanks, Teague.
Thanks, guys.
Great seeing you guys. Take care.
See you guys.